going public is not for every CEO. It's an extremely challenging role to be in at a founder.
What do you typically see as best practices for lockup periods currently in this market right now?
I think the biggest misunderstanding for those that are interested in the small cap and micro cap is that you don't have to be a giant unicorn and VC-backed company in order to go public.
Hey everyone, welcome back to Fundraising Demystified. Today, I'm inviting back Peter Goldstein, the expert in the IPO market, also the author of the Entrepreneur's IPO and soon to be author of the Investor's IPO. Peter, welcome back to the show.
Thanks, Jason. Great to be here again and excited to have another, in-depth conversation about the IPO market and all of the complexities that surround that in today's day and age.
Yeah, there's a lot of questions that I have because, we're talking today at the end of March, so end of Q1 2025. There's been a huge kind of market scare and kind of drop in the last few weeks, the last month or so. IPO markets where everyone's begging for liquidity in the markets, and yet there hasn't been any major activity, but a lot of talk. So to kind of kick things off, being that you're called the resident IPO expert on our show, I'd be curious to hear your thoughts on kind of what's your take on the current IPO landscape for 2025.
Yeah, there's no straight and direct, easy answer to that, Jason, right? These are complicated times. And the optimist, because I'm a very forward-looking kind of optimist, I'm very pragmatic, but I think that in the volatility that we're seeing, after we get a few successful large IPOs, which there are some teed up right now, we'll see the market open up. We've had a pent-up demand, and the pipeline is very full on the IPO side, and the capital is waiting to be deployed. So what I've seen before, as last time was in 2021, where once the market opened up, there was a significant number of entries into the marketplace. So time will tell. I think that really we can talk about some big ones that are coming up that are very significant in the tech sector and the AI sector. And when these anticipated IPOs come and they open up and they perform well, then that will really shift the IPO market as we know it today.
How important is timing for these companies? I imagine that's why they're holding out for so long, but how much does timing impact the decision to go IPO?
Timing really is critical, Jason, because there's a number of sensitivities here. And that's the complexity of an IPO coming in together is that you need to have the market conditions, right? Your underwriter needs to be aligned, management needs to be aligned, and the board needs to be aligned. And so typically the sensitivities are around bringing all that together. And let's be honest, it's about valuation, right? So the demand for the stock, IPOs have a limited supply of stock. Every one of them is only issuing so many shares. So then it really comes down to that timing relative to all those factors coming together under one unique time frame.
What are you seeing behind the scenes right now when it comes to companies looking at going IPO? I know your specialty is more the micro, small cap, but from an investor sentiment, so the investors that have a bunch of dry powder sitting on the sidelines, waiting to see what happens, are you seeing a lot of companies going on roadshows, entertaining and winding down these investors right now, or are people still kind of in a holding pattern waiting for better times?
I think what companies are doing, preparing, the smart management teams understand that it takes time, that you can't just roll out an IPO overnight, right? So companies that are even able to file confidentially with the SEC allows them to put together the infrastructure and being what I would call IPO ready. And I have a great saying, Jason, if you're IPO ready, you're ready for anything in business. So it takes, a very strategic management team to understand all the different stages of being organized around an IPO. And there are regulatory restrictions. You necessarily just go out and roadshow. You can't necessarily solicit and announce your IPO unless you're under the certain confines and constructs that are, allowed through the regulations that the SEC provides.
I guess from the investor sentiment, what are investors wanting right now? What are you seeing on the investor side?
They want it all. They want, and they have the ability to be very picky and choosy about it. So, what is that? Valuation, growth, right? Solid management team, And I think overall that it's a company that really is truly positioned properly to bring that together in the open markets with liquidity. And that takes, really kind of that orchestration. Investors have the ability now where they want to know that, look, let's be very clear about it. Many of the IPOs haven't traded well in the open market. And while there's an overall return, there's a lot of concern there. And so that's why the money is somewhat on the sidelines. And yet that money, Jason, has to move. The money has to come into the market in order to get a return on its investment. So that selection process of bringing it all together is really what the investors are looking for in today's market.
Well, it's interesting because I was looking at a recent stat on the secondaries market, and I think it was like went up from like 40 something billion a couple of years ago in total transaction volume to like 140 billion in last year. And to see that kind of uptick, is that like, why do you think investors are pouring so much money into secondaries right now?
Well, again, because the money really has to come into the market for the investors to get a return on their investment. It's not, if they're not in the venture capital or private equity market and they're investing in liquidity and investing in the public markets, then that's the mechanism for their money to get in at a reasonable discount, right? They can always buy in the open market, but secondary typically has better terms for the investors than it would if you're buying in the open market. Or it has the ability to come into the market knowing that there is a significant event and opportunity for those investors to get a return on their investment. So the secondary market, I think, will continue to grow as an alternative to those companies that are already public, because those companies need to seek capital to continue their growth, right? These companies went public at whatever time frame they did and are able to take advantage of access to capital, whether it be a debt, equity, or some structured financing.
Yeah, and I think it's a bit of an anomaly. What we're seeing is like, I think it was almost like 70% of all that capital went into just 8 companies like SpaceX, OpenAI, and things of that sort. And for them, it's basically like being a public company at that point with how much liquidity there is for their stock, and it allows them to have full control. But when you think about the other 20%, 30% of the secondaries capital being distributed amongst hundreds or thousands of companies, it's a lot less liquid for those guys. And I guess that kind of brings the point of why maybe considering a micro cap or a small cap listing might be more advantageous. So, give our audience that maybe didn't watch our first episode together, which we'll link in the description below. But what's the difference between like small and micro cap versus kind of these mega behemoths, the decacorns that are still private?
Yeah, I think the biggest misunderstanding, Jason, for those that are interested in the small cap and micro cap is that you don't have to be a giant unicorn and VC-backed company in order to go public. So by definition, microcap is $50 million to $300 million market cap. And then from 300 million to $1 billion is small cap. And these are kind of the future stars, right? These are smaller growth companies that are looking to seek capital and liquidity at an earlier stage in their development than they would be if they were a bigger VC-backed or private equity-backed company looking for an exit and liquidity. And that's the sector that I work in. It's much more emerging growth. We have now some interesting stats around that. In 2024, Jason, 60% of the IPOs that were coming in as small cap and micro cap were foreign companies. And those are companies seeking access to capital and liquidity that are emerging growth companies outside of the United States. So we have this kind of, blend of opportunities, not just with emerging growth companies, but in emerging regions of the world that bring the credibility, the regulatory oversight, the transparency by being a public company here in the United States on a senior exchange.
So you said 60% of the micro small cap listings were international companies?
Correct. Yeah, what they call foreign private issuers.
Okay.
And those foreign private issuers use a form with the SEC called an F1. So it's a different registration process for the IPO, but the listing ultimately is the same, where the common shares are traded on the open market in both the NASDAQ and the New York Stock Exchange. So there's NASDAQ Capital Markets and New York Stock Exchange American.
So in your experience, kind of seeing this landscape, like how are those companies performing? How's the general micro and small cap market performing?
Overall, very disappointing how the stocks are trading in the open market. So that's one of the sensitivity items, right? There are, just like in any market, there's going to be, the exceptions to the rule, and those that are well prepared, they've taken 12, 18, 24 months to prepare. They have the proper infrastructure, proper investor awareness program, and they have a growth trajectory and a strategy for entering the public markets. Those are the ones that perform well, and those are the management teams that we work with, and really have seen the distinction. But I think you see it all the way up. You see it micro, small, mid, and large cap. That those characteristics of a successful IPO cut across the board in every sector.
So, yeah, a part of every IPO, there's, usually, unless it's like a direct listing, but in most cases, there's an IPO and there's initial investors coming in and buying up the IPO shares. Who are these investors that are buying up micro and small cap shares at IPO?
It's a blend, Jason. You have, I would take it from the bottom. You have retail investors, and what's changed significantly is that 20 to 25% of the buyers in those IPOs end up being retail-based investors, and these are accredited investors, high net worth. The advent now of technology and trading platforms has opened that up to investors to participate and get access to these smaller IPOs where they never had it before. And then you have a blend of family offices and kind of special purpose, but fundamental institutional investors. And those are investors, and they're hedge fund oriented, that are higher risk, or at least take a portion of their portfolio that's designated for this higher risk category in the emerging growth sectors.
So, I guess walk us through some examples of deals that you worked on that you were there in terms of advising from start to finish and kind of seeing how they perform. Like, what's kind of an interesting story of one of the companies you've worked with?
Most of so I've had a very kind of quiet last year because of the markets, and we're selective, like many, about those that we work with. And what we've learned is, one example of a med tech company, and med tech and life science are unique because they're either pre-revenue or they're early revenue. And we also invest in these companies before they go through their IPO. So we're able to fund the company for strategic growth capital prior to its listing. We listed them on the NYSE American. And then from there on, they've had their journey continue on, where they've raised, 3 times the amount of the initial IPO in the secondary markets to help to support their growth as their revenue and the life science, and in this case, medical technology, comes on board. So what I really look for is a fundamentally good growth story, solid management that understands the capital markets, support of a board to bring that in, and then the ability to know that in the next ensuing 12, 18, 24, 36 months, like with this company, they're going to be opening up and developing their market with a strategic rollout. And then this capital, Jason, becomes really transformational. If you look at some of the bigger anticipated events that are coming out right now, and some of the big IPOs that are coming, it's not as much of a transformational event. In the small cap and micro cap, these are going to be transformational forms of capital that will take a company from its early stages of growth and accelerate it in the next 18, 24 months. So, we're seeing obviously some of the big ones, right? Like Klarna as an example. If we go back up the food chain, Klarna was expected to go out in 2021.
Yeah.
And it didn't happen, right? And it's similar with the company that I just told you. We were able to do it because there's smaller amounts of capital. When you're talking with a valuation of, let's say, whereas Klarna was $12 to $15 billion, that's significantly different than we're talking about $120 million microcap offering, right? So, these are going to be very interesting bellwethers for the market as we look at the differential between the large cap and the small cap and the microcap offerings.
And let's just say, Klarna, Corey, these, bigger companies that have had tons of secondary, and there's been a lot of liquidity on behind the scenes. When they go public, if they are up into the right, I think everything's gonna whole market will probably rip with it. But if they don't go up into the right and they flatline or they start to tank, do you think that's a direct correlation to the small caps and micro caps, or do you think there could be some other potential for those companies?
I think there is a correlation. It's just generally speaking, the IPO performance is going to affect every sector. And obviously, Databricks, Stripe, Klarna, CoreWeave, these are big names. And investors, will be able to demonstrate their appetite. So you have AI focused, right? You've got technology companies. There's been very strong interest and investor sentiment around every one of these sectors. So with that substantial interest from investors looking for the growth opportunities and, tech and fintech especially, that the performance of these IPOs is going to impact all of the other sectors, and in a positive and or potentially negative way. So, we're watching all of those very, very closely because the pipeline is filled. And what we've seen, Jason, once the pipeline opens and the window is open, things move incredibly fast then into the marketplace.
No, I think that's going to be very exciting. I think if any of these big, private companies have a successful IPO, everything's just going to rip wide open. Imagine the floodgates will be open and everyone's going to be trying to get in there. Everyone at least that's been prepared and has done their diligence in prior. But when it comes to getting these, as a founder in a founder mindset of looking at your options for liquidity, either to fuel growth or for existing investors, yourself or whoever, to kind of get liquidity. When they're looking at an IPO, obviously they want a great outcome. And you can do your best to kind of, do the roadshow, set the price and hope for the best. But in the event that you go public and you don't really know what's going to happen in the macro market, and that's a risk you take, what's some words of advice to those founders that might want to, know what happens after IPO in terms of the good, bad, and the ugly?
Yeah, it's really about the long game, Jason. You're right. There are options, right? An IPO is just one of them. You could continue to stay private, seek venture, growth capital, look at funding from PE or from other sources. And then, of course, there's the optionality, and most investors that would take that route are looking for liquidity at some point in time. More companies are staying private right now because they have access to capital and they have access at high valuations with less volatility in their price. So, there are benefits and there are pros and cons. Obviously, going public is not for every CEO. It's an extremely challenging role to be in as a founder, to be in that position where you're really, in a sense, running two companies. You have the operating side of your business, and then you have the public-facing side of your business. And so I actually try to really talk people out of this. We need to know that they're fully focused for the long run if they're looking for short-term gains. Founders and CEOs don't typically take money off the table at the IPO. Investors don't want to see that. So there's a lot of misinformation. When I took my first company public, I thought once I got listed, all of my issues and my pot of gold would be waiting for me. Didn't work out that way, and it doesn't work out that way in reality. So, the advice is, if you're going to go, be fully ready and be fully prepared. And that's a very robust plan. Have a right team around you, have the right advisors around you, have people who are experienced, not just in the IPO market, but in today's IPO market. Because it's different, Jason, than it was in 6 months ago, a year ago. There's an old joke in our industry, if you've done 2 IPOs, you consider yourself an expert. Well, I like to look at in what time frame and in what sector, and how does that relate to the companies that we're working with. And so when we bring in, a CEO, we spend 12, 18, 24 months working and prepping and educating for what it's going to be like. And then, of course, there's no certainty. So that's both on the positive and on the challenging side of being in the IPO market. So it's a long run, long view perspective that you have to have, where you're not going to be looking at the stock ticker every day and focused on the volatility in your stock, but you're going to be understanding that this is going to give you access to more capital, right? Credibility, visibility, liquidity, and that's got the benefits that far outweigh the risks. And of course, in my opinion, because that's the sector that I'm focused on.
You're likely having trouble raising money or selling your company. Personally, I've had 4 exits and I've raised over $145 million. If you want a free coaching session with me, Just like, subscribe, and leave a comment down below letting me know what you think of today's video for a chance to win a free coaching session with me. I'll select 3 winners every single month. You just have to like, subscribe, and leave a comment down below for a chance to win. Now, onto the video.
No, I think that's an interesting perspective. And then, you kind of bring at this point of like, okay, just because you went public doesn't mean it's payday for everyone. Because one, who knows how the stock performs, but two, there's typically these things called lockup periods. Like, what do you typically see as best practices for lockup periods, currently in this market right now?
So there's 2 stages, and I think it's also important for the investors that are listening to understand if they're investing in an IPO. The first one is a 6-month time frame, and prior investors to the IPO are typically locked up for a minimum of 6 months. And when those lockups come off, and this is what's interesting for investors, you want to be tracking that time frame because there's likely to be a sell-off then. There's certainly more shares that are available to be sold. And many of those investors, Jason, have been in this company for a very, very long time. And so they have their own sentiment around wanting to sell and the ability to sell after that first benchmark, which is 6 months. The second one comes at 1 year. And insiders, founders are often locked up for at least 1 year from the IPO. And so that's the second tranche. Of course, insiders have to record any sales, so you don't know if that's happening. But the really key markers there are watching what happens with the stock after the lockups come off during that 6-month and 12-month time frame.
So it's important for founders to know it's like you have to continue to operate this business, because I know plenty of stories, especially 2021, founders took their companies public but had the 1-year lockup and lost 50, 75%, 80% of the value by the time the lockup was over and they were able to sell their shares. And it was a meaningful negative impact.
Yes.
Now that was more macro than, the valuation is probably too high to begin with, and macro market, things of that sort. But, how important is it for founders to think about, pricing? Because everyone wants the highest valuation, but is it a valuation they can live up to? What are your thoughts on that?
Yeah, I'm a big believer, Jason. The market's really going to set your valuation for you. And what I mean by that is when your IPO comes out to market, typically there's a range. And demand, if it's strong, will have your IPO done at the higher range. If it's soft, of course, in the way of demand from investors, and your IPO is likely to price at the lower end of the range. And so that takes a lot of work to understand who are your comps, right? Comparable companies in your sector in the marketplace. How are those performing, right? What is that kind of bundle look like in the open market? And then to be able to set a realistic valuation. And I think, honestly, one of the reasons why more companies aren't coming is because they've gotten very high valuations in their private life. And they don't want to do necessarily a down round or a round that would be below the last valuation. And so if you go out too high, then of course you're going to have a lot of pressure on your stock. And then you have the herd mentality. When stock is pressured and the stock tends to go down, then people unfortunately tend to want to sell and jump onto that kind of herd mentality. So valuation becomes a very, very critical piece of your IPO. And of course, that has to be matched up, not just at the time of the IPO, but with the prior rounds of financing, and being able to build in a price point that's attractive to bring strong demand. If the demand is there on the IPO, then you have a higher likelihood of buying in the open market with an uptick. If the demand is soft, then obviously you run the risk, as you said, of the price, getting under pressure, and then the valuation being eroded for all of the stakeholders.
So for founders out there that, want to consider this, what would be some of the check boxes that you would look for in a company? So you mentioned something like management team and sure, but what are some of the hard, concrete, either stats, you need to be growing X year over year, you need to be, because it has to be marketable. Anyone can fill out documents and file for an IPO, but at the end of the day, there's going to be buyers on the other side that think you're attractive. What do founders need to consider when taking a company public?
If you want a growth marker, for me, it's 30% minimum year over year growth. and not just the company's growth, but inside of a sector that has a large addressable market and is growing itself. And that could be niche, it could be geographic, it could be macro, but you want to really align, the company's growth inside of a growing sector. Those are critical markers for us. And you don't want to take out a company, obviously, that doesn't have that trajectory over the next 12, 18, 24, 36 months. Beyond that, Jason, no one knows what's going to happen, in this complex market. But I look at 3 years and 3 years, and then we work backwards from where would we be then into now, and look at the assumptions that are made to be able to support, those growth projections and the strategy. Organic, and it could be inorganic, meaning that could include an M&A, which is really a robust opportunity to grow your business inorganically. So the strategy, in order for not just where your growth has been historically, but what it's going to be coming up in the next 12, 18, 24, 36, to keep on that growth of a 30 to 40%, annualized.
So having a clear growth strategy to maintain that 30% year-over-year growth, whether it's, growth buyout strategy, buying up competitors, or consolidating, or whatever it might be, or just having a clear definitive sales plan, like market. But I guess from like a revenue or EBITDA, like, are there certain kind of baselines that you would kind of encourage founders not to really even consider an IPO until they hit certain benchmarks there?
I think it's more about cash burn, Jason, than it is about revenue and EBITDA. And tech companies and other companies that are coming out, it's really critical to understand your burn rate. In our sector, small cap, micro cap, a lot of these companies are not yet profitable, but that happens all the way up the food chain. And so, I'm more focused then on companies' capitalization, its strength on its balance sheet, both coming into the IPO and once the company is further funded.
So you're saying like companies could be like $50K a month burn rate and 5 million revenue and go public? Would you advise that? Or would you be like, no, wait until you're like 25 million, 50 million?
Well, again, there's a market cap measure here, right? So, if you're putting a $50 million valuation on a company, there has to be enough of a multiple to support that in the way of revenue. So for us, 10 million in revenue is typically a floor, right? And then up, there are companies that are below that. That could be life science, it could be med tech, it could be something that needs time to develop, the intellectual property and to be able to bring that out to market. But anything realistically, and there are some new rules that have come out, Jason, that'd be interesting to share with you. So NASDAQ has recently changed and has SEC approval to have a minimum capitalization in the flotation of shares of $15 million. So that sounds small in the big world of IPOs, but there were a lot of number of companies, to your point, that were smaller, earlier stage, that had a bigger cash burn, that were raising less money than that and entering into the markets. And so now there are new regulatory guidelines that have put a floor to the IPOs at $15 million and above, which went away after 2021 with basically underwriters and companies getting creative about ways to enter the market. And unfortunately, that creativity really didn't work very well, in the sense that these were thinly capitalized companies with a high burn rate, and they didn't have the revenue streams and the institutional support to be able to maintain, that stability that's needed in the open markets.
What do you think drove that? Do you think that's like founders leading that, or is that like advisors trying to make, investors trying to make fees and trying to make a quick buck, as opposed to what's actually materially valuable for the company long term?
All the above, Jason. It's Wall Street. It's and the micro cap and small cap markets especially are very opportunistic in a sense. And I tried to bring different leadership and integrity to that, so that, we're really selective about being able to protect all of the parties involved, including the founders, but nobody really wins, maybe outside of the people that get paid in transactional fees. If a company enters the market and it doesn't perform well, isn't really organized properly, isn't structured, isn't educated about what it is to be a good, solid corporate citizen as a public company. That sustainability is one, again, that we've seen time over time. You can't rush into the market. You can't be underfinanced. You need time to prepare. You need time to make sure your management is ready. Your board is supporting that you have that growth trajectory. And, one of the things I love about what I do is there's not one particular area. It's all of this from a 360-degree perspective. And yes, Wall Street is built on greed. So FA financial advisors, other participants in the sector are looking to bring transactions together because that's how they make their money. I like to look at it very differently, which is how is this public company going to operate in the open market? And have they taken the time to prepare, to organize, and to set themselves up for success in the open market?
So I think it'd be good for us to educate founders on, kind of these two different paths because venture has just become the de facto path for so many, companies. But there's a certain point where I think founders really need to consider this, where they might, because 30% year-over-year growth is no longer venture sexy in most cases. And at that stage, say you're a great company, you're doing well, but you're not 1x, 2x year-over-year growth in a hot, sexy, category. And maybe you raised venture previously. So I know a lot of companies that have some pretty high pref stack. So for the audience that doesn't know what a pref stack is, it's when you have, let's just say you raised 40 million on a 1x pref, you have to clear 40 million and then there's disbursements to the rest of investors if there's an M&A activity or something of the sort. So when these companies that have these large pref stacks that are no longer going to be able to raise follow-on funding from traditional venture, how should they look at this path and what would be the net benefits of considering going public versus, trying to chase VC or maybe growth equity?
I mean, it just starts with access to capital. You have a much broader pool of investors and investor base. And one of the things that I would focus on is control, right? You just mentioned in these pref stacks that, the prior investors have a significant amount of control over the entrepreneur and the founder and the management teams and how they're able to navigate, and it diminishes that options. So one of the tools that is used in these smaller companies going public is to separate the shares so that the founders and the management team can still have voting control. And that gives them the ability to access capital without significant dilution while they're opening up the pool to both institutional debt and institutional equity participants. And so it really, this becomes, choosing your lane, Jason, right? And looking at the opening up. And really the other critical component that I think most founders should consider is using that stock for other purposes, right? So that's to be able to reward your employees, to attract employees, reward them, your stakeholders, right? The credibility, the value that comes out of the intangibles. So you have your quantitative and the qualitative. And I think the qualitative is often overlooked as another benefit from being publicly listed.
So to kind of recap, I would say for founders that are considering going public, the pref stack effectively gets eliminated.
Yep.
So when you go public, correct? There's no retention of that pref stack. So maybe you overraise at a too high evaluation. You might take a haircut on valuation, but you eliminate that pref stack, which could make a material impact and gives you more control potentially over the board and voting control. Because in most cases, those investors would probably move on that were previously on the private side, and new public investors would step in. Is that a fair assumption?
100%. So not only do you remove it, but it gives you a whole new world of optionality. And then you have the ability to utilize all of those tools that we discussed.
Yeah, especially for growth buyouts. We're working with a company now where, the idea of going public makes a lot of sense because, they're a strong number 3 in their market, but to kind of get to number 2 or number 1, they want to kind of consolidate, be the first to start consolidating the market beneath them. And as a private company, you're kind of coming out with these phantom shares, come in with this. And it's just I see so many people on the sell side that get those offers and turn them down because, they're usually overinflated valuations. There's no way to really know what's going to happen. But if they get an offer from a public company, then they can actually count their chips and be oh, okay, that's actually how much these shares are worth right now in the market. Here's how they've been performing. okay, this is a serious offer that we can consider if they're offering stock. And it makes a material difference in M&A discussions if that's a particular path for a company.
Couldn't agree more. And I think it's often overlooked. You're using stock as a currency now in addition to the capital. And then, of course, there's additional capital just for acquisitions. There are a number of investors that, support a roll-up strategy or an M&A growth strategy. That would really then give you the ability to have access to being able to buy those companies with stock, right, with a blend of equity and with debt. That's how I took my first company to NASDAQ, was we did a roll-up after roll-up after roll-up. And for those companies that want to grow their market share, I don't know of any faster way to be able to do that than to build a well-capitalized M&A strategy along with utilizing shares with a mark-to-market. So the big difference there, of course, is you have fluctuation, but you have the ability to do mark-to-market when you're utilizing those shares as currency in the M&A strategy.
Gotcha. So just for fun, could you tell the audience a little bit about I know it's a little while back now when you did that strategy, but kind of walk us through what the company was, why you decided that growth buyout strategy was a good growth strategy for you guys, and kind of how did you guys go about funding that?
So we were in the staffing sector, and what I was looking for, and this is quite some time ago, so I'm going to date myself, but really, Jason, what it was finding smaller, fragmented space that could be aggregated into a much larger sector. And that exists in many, many different spaces around the world and in industry sectors. We chose that because we had a foundational company. That was the core that we started with. But when we began that journey, we didn't have any organic operations. And this is part of what, the journey was like when we wanted to start with. We were brought an opportunity that we wanted to buy, and then we saw and did our homework and diligence on the sector. And what we found were, very, very profitable, but small, fragmented companies that would hit their ceiling in the $5, $8, $10 million range. Again, we're small cap and micro cap. But then we began aggregating those one by one, and it was kind of high-end staffing, white-collar staffing, if you will, cyber, accounting, were our focus around, the areas that we began, where it was just an arbitrage play, right? We're buying them, let's say back then, 4 to 5x on a multiple, and immediately we're getting a double, and then growing those and aggregating where that double increase in value would turn into 3, 4, 5x on return as a total bundle. And it was a great exercise. Taught me, obviously, the benefits of being able to use a blend. And what we did, I'll just give you my formula, was a third stock, a third debt, and a third equity. And the management teams of the target acquisition had to stay on for at least 3 years. So we knew we were maintaining the human capital along with the ability to grow and aggregate those through an M&A strategy.
Good. I would say equity. Was it, so you did third stock of your stock, and then you raised a third of it in debt, and then the third equity, that was cash coming out off your balance sheet?
Correct.
Okay, gotcha. Yeah. Good strategy. It's kind of safe enough, kind of like blends it all. And kind of what was the outcome? You went through that path, you executed on that strategy. What was kind of the outcome for you at the end?
So for me, founder, chairman, we brought in, much more experienced management than I was in the sector, who took over, and then I took my exit. So it was a good outcome. Everybody won, and that's what I, obviously look for, in the transactions that I'm involved in. When you have these small private companies who don't have an exit strategy, they don't have a succession plan. This is like a really great way, and I think there's more and more of those right now, given the boomers who didn't plan on well organized and aren't big enough to have the big VC-backed exits or the PE exits. And so those are the companies that and I'm an entrepreneur at heart, Jason, so I really love working with, people who have dedicated their lives and careers and their identity around building a business that then have an alternate strategy that they didn't have before.
I appreciate that, Peter. I think those are pretty valuable insights in terms of what we're looking into in terms current markets, as well as just some common good advice for founders to take into consideration for going public. Peter, can you share a little bit more about the Entrepreneur's IPO and your new book coming out, The Investor's IPO?
So the Entrepreneur's IPO is a lot of what we've kind of still talked about here today. It's a go-to, step by step. Thank you for the plug, for the shameless plug.
It's a good book.
But it really is. There's when I took my company public, I didn't have any place to go to give me the knowledge that's practical and actionable to enter into the public markets. Of course, I could talk to a lawyer, I could talk to a banker, I could talk to my auditor, but they weren't really giving me the business counsel and the knowledge base. So during COVID, I decided to write the book and put it out, really designed for small cap, micro cap entrepreneurs and founders. And what I've learned since is that, two things. One is that any founder, CEO, entrepreneur can benefit from an IPO organized mindset. Meaning if you stay private and you never want to do an IPO, there's value to you when you're running your organizations with the controls and the systems and the accountability that comes to your stakeholders. So I think it's a good read for anybody, even if you're not considering an IPO. And then separately, what I realize is that IPOs have a lot of mystique around them, a lot of kind of smoke and mirrors, and they're largely misunderstood. And so the bigger pool of opportunity comes in those investors who are interested in investing in IPOs. So I decided to go about taking and informing investors on what it is to get access, how to look at IPOs, how to understand them, how to really look at the process more from the investor filter versus the entrepreneur's filter.
And that comes out in July, you said?
Comes out in July, to be released, July 9th. I'll be in Singapore, and we're releasing the book to a large audience of investors at that time. Happy to share it with you when the time's right.
I'll be happy to read it. Enjoy the first book. It is just a straight to the point, like, here's what you need to be aware of. Here's what you got to do. Not a lot of fluff, not a lot of extra stuff. It's pretty short and to the point. So I appreciate that. And then for founders that are interested in maybe getting in touch with you, either to talk further about the consideration of IPO or just the public markets in general, what would be the best way for them to learn more about you and get in touch?
The best and easiest is just reach me on LinkedIn. I'm quite active. I put out a lot of information around the IPO market, around the capital markets, around entrepreneurship, because I'm very passionate in helping and assisting entrepreneurs in their journey. So just connect with me on LinkedIn. Feel free to send me a message, and I'm happy to chat just about anybody about the topic.
I really appreciate it, Peter, and thanks again for being on the show.
Thanks for having me, Jason.
Thank you for watching today's episode. As a reminder, I'm your host, Jason Kirby. I have built and sold multiple companies with over 135 million in transactions as either a founder, operator, or investor across multiple industries. I'm currently the managing director and founder of Thunder.vc, where we help companies and founders at all stages navigate what capital to raise and who to raise it from, and help improve companies' odds of raising the capital. If you need help, reach out to us at help.thunder.vc. If you like today's show, please share with your friends, give us a like or a comment down below. And as a reminder, this show is published weekly. And to get notified of new episodes and our newsletter, be sure to go to our website at join.thunder.vc. And if you sign up today, I'll send you a few freebies on how to negotiate a term sheet, how to get a free list of relevant VCs, and much more. That's it. No more shameless plugs. Thank you, and see you next week.